market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, let's start with the latest from Washington. And Elon Musk and one of his children made a rare appearance in the Oval Office alongside President Trump to defend his moves to dramatically cut federal jobs. A White House fact sheet seen by Bloomberg shows the agencies will be permitted to hire no more than one employee for every four that leave. Now, Musk claims he's trying to make things more open.
Transparency is what builds trust, not simply somebody asserting trust. So not somebody saying they're trustworthy, but transparency, so you can see everything that's going on. And then you can see, am I doing something that benefits one of my companies or not? It's totally obvious.
And we thought that we would not let him do that segment or look in that area if we thought there was a lack of transparency or a conflict of interest.
Let's bring in our EMEA News Director, Roz Matheson. Roz, I know there's been a lot of pushback in saying, look, the numbers are too big. Maybe it's the good people that are leaving. It's still early days, but what do we know about how, of course, Elon Musk is trying to hollow out the U.S. government?
Well, as you were just saying, showing like quite stark images of Elon Musk in the Oval Office yesterday with Donald Trump, as Donald Trump instructed agencies to work more with Elon Musk and his cost-cutting effort to say, we've got to reduce the size of government. We've got to shrink our workforce to only essential workers. But of course, the challenge is, what exactly does that mean? We've seen this administration come out with quite a lot of very broad orders in the early days, you know, funding freezes and so on, and then enacting it becomes very complicated because people are trying to interpret what exactly is feasible in that, what is legal in that, and what is practical in that. And that's really the challenge that we're seeing with this cost-cutting effort across the board, because it's ranging across so many departments with so many orders, you know, offers of people to take buyouts, but which departments and what kinds of workers? And are you risking letting go of the people who really have the most value to the administration that they're working for? And so a lot of confusion around how do you enact things, even if you are trying to do the right thing by this administration, and again, what's feasible. And it's really hard to tell at this stage what the impact is in terms of the functioning of the government, the functioning of the payment system, and so on.
Ross, we're also 2 days away from the Munich Security Conference. Donald Trump is hinting at possible progress in ending the war in Ukraine. What do we actually know?
Well, interesting to see. We've got, of course, the U.S. Treasury Secretary Scott Bessent going to Ukraine to meet with Volodymyr Zelensky, and perhaps a conversation there about what's feasible. And it's all building to this idea that the U.S. is going to come out with the, you know, perhaps more of the meat of a plan this weekend, even at Munich, in terms of what they see as feasible to bring this war to some kind of conclusion. But there's a lot of moving parts here still. There's a lot we don't know. What exactly will Russia want to come to the table with? What would Ukraine? Is there going to be a negotiation over land? How does that play out? So it's obviously coming to some sort of conclusion, potentially. But there's a lot still we don't know. We maybe get a bit more clarity this weekend on that.
Roz, thank you so much. Our EMEA News Director, Roz Matheson. Now, Bloomberg has also learned that authorities in Beijing are working on a proposal to help China Vanke plug a funding gap of about 50 billion yuan this year. Now, as part of that proposal, regulators will allocate 20 billion yuan in special local government bonds to buy unsold properties and vacant land from Vanke. Now, for more on this Bloomberg scoop, John Liu joins us now. So, John, what are the details of this plan that we've learned about?
Well, I think we've learned two things, Francine. One is the size of the hole that Vanke is looking at. So when we say 50 billion funding gap, that's the difference between what Vanke owes this year and then how much on hand it's readily right now able to pay. Now, the difference, the second thing we've learned is the government is coming in to try and find a way to help Vanke close that gap. So you mentioned the 20 billion yuan of special bonds that local governments around the country will be allowed to sell. The money they raise from those sales will be used to buy unsold homes from Vanke. That should replenish some of the revenue coffers for the company, which they can then in turn use to pay back some of that debt. Vanke will also be allowed to sell more bonds and to take out more loans from Chinese banks as another way to try to bridge this difference. And of course, the company has also said itself it's going to be trying to sell some of its assets and looking for whatever cash it can generate from the assets that it has on hand.
So this probably the worsening property market or crisis is really probably coming at just the wrong time for China, given also what's happening with Trump policies. So what could this mean for the broader property crisis, John?
I think if you look at the way that the market has reacted to this news, Vanke shares are way up, the bonds are trading higher. I think that shows not only is the plan, the details of the plan very important, but the fact that the government is willing to step up and try and put a floor under Vanke and I guess in turn the broader market. This is not the sort of help that others like Evergrande got when they got into trouble. And so this does mark a change in policy and in behavior by the Chinese government. It shows it's willing to do more. I think that if that plays out the way I think the market is expecting, that could make a big difference in terms of the direction of travel for the property crisis here.
John, thank you so much. Bloomberg's John Liu there, who leads, of course, our greater China coverage. Coming up, UniCredit's Chief Executive Officer, Andrea Orcel, will be joining us to discuss the company's fourth quarter earnings, but also M&A ambitions. That's next, and this is Bloomberg. Welcome back, everyone. Now, UniCredit's chief executive wants to decide by the end of the year, this year, whether to make a takeover offer for Commerzbank pending the new German government's willingness to allow the deal. Now, this comes as the Italian lender reported record profits for the fourth quarter. Well, Andrea Orcel, the chief executive of UniCredit, now joins us. Andrea, as always, thank you so much for giving us a little bit of your very busy schedule. Now, you had some very good earnings. When you look at the levers of what rates are doing and the, I guess, underlying nervousness in the global economy, what do you have to pull on to make sure that you're on target?
Well, Francine, I would say that we have waited for this moment for the last 4 years. We crowned 16 quarters of profitable growth. We are well prepared, and we've laid the foundation for the next 12. And if you look at our messaging, not only did we reach record results of 9.7 billion, but we absorbed more than 1.3 billion on extraordinary charges and reinforced further our provisions and kept intact our overlays. So for us, this was the start of the next 12 quarters where 12 quarters where we would be more focused on growth, and we would be in a position to offset the normalization of rates. So we've said that this moment was going to come. As we are today, I think we have one of the very few banks that will be able to keep costs flat in the next 3 years, that will be able to keep cost of risk flat in the next 3 years, and that has built factories to such an extent that our fee income will be able to offset initially most, but increasingly more than proportionally, the compression of NII coming from rates.
So whatever happens, that will be under control, and then you have all the M&A that you're possibly looking at.
Well, you can never say whatever happens, but I think we're very, very confident on what we're going to deliver. I think this year is not only for us a record in terms of net profit, profitability, and distribution at 9 billion, it's also the start of the next 3 years where we want to first match and then increasingly beat that.
Andrea, talk to me a little bit about Generali. I mean, there was a bit of a surprise that you were above 5%. Can you break down the numbers in terms of what you have for UniCredit and what you're holding on behalf of clients?
Well, let's say that the investment in Generali is, for us, as I have said, completely financials. We have no intention to buy or move strategically on Generali. They have been partners of ours for a long time. We distribute their products in a number of markets. We might be distributing some of their asset management. And it was the right thing to do when we built it up. It was leaked. When it was leaked, we said that our client had about 0.6%. We were at about 4.7. Now we are just over 5. Honestly, I don't think it's very significant.
I mean, there's quite a lot of people in Italy that's saying it also gives you leverage to negotiate with the government or the parties into what you're trying to do, but with Banco BPM. Is there any truth in that it's a good investment, but also, it gives you an advantage?
Look, it's a good investment, and we obviously, by having these stakes, we're a party to talk to. I wouldn't go as far as putting it as leverage or looking at a theory of a coordinated approach on BPM.
So it's nothing more than actually, you find it a good investment.
For the time being, it is a good investment that has returned well. We built it over several months, and we're sitting on a good capital gain, which is partially a hedge. So for us, it's a good thing for the bank.
Andrea, talk to me also about Commerzbank. So we had a lengthy conversation also in Davos. It seems that German officials are doubling down on not wanting to sell you the bank, frankly. Even if there's a change of government come February 23rd, do you see the tone changing at all?
Well, I don't know. From our standpoint, we were invited. We did what we said we would do, because as we were invited and we crossed to 9%, we said we would reach 29. We reached 29. We said we would ask for authorization from a regulator. We asked for that authorization. We also said when the tone changed that we would wait and not launch a transaction until we had the opportunity to sit down, go through the details, and explain the benefit that this transaction has, not only for the two banks and their stakeholders, but also for the sector, German industry, and Europe. So we're optimistic that when the emotions are off the table and we can focus on what this really is and what it brings, we're going to be successful in having support.
And I know you said that you'll only decide, I guess, in a year if you go hostile or not. Is this something that's on the table?
It's just that if you look at the timeline of elections, of forming a government, of having discussions on everything else, you're looking at 3 to 4 quarters minimum. And therefore, that allows us, as an investor, to have an influence on Commerzbank, see what the performance really is going to be, and then take a decision when we have all the elements.
We also understand that Commerzbank is changing their strategy or adjusting their strategy this week, maybe also to fend off a possible bid from you. What would you do differently if you were in charge of Commerzbank?
Well, look, I think we'll see tomorrow, but we all would be surprised if the plan was not optimistic. It always is when someone tries to fend off attention that they're not pleased about. I think for me the important is, does the plan strengthen the bank? Mm-hmm. People overly focus on cost reduction. I think it is, does it strengthen the bank? Which means you search for efficiency, targeting your cost reduction in the areas that do not add value, that are duplicative, that are overhead, etc. But you then use a lot of that money, in our case more than 2/3, reinvesting the bank in technology, in data, in the network, in the factories, in strengthening the overall bank and in the people. I think for us, seeing plans that go into this direction, which we feel is our blueprint, gives us comfort. Seeing plans that just put up reduction doesn't. More importantly, specifically with respect to Commerzbank, I would say that there is concern on the state of their technology, the obsolescence, the fragmentation, whether or not they have ever integrated the two systems of Commerzbank and Dresdner from the acquisition, whether they're investing enough to modernize as opposed to just run. And their corporate center. Their corporate center has almost 45% of their assets. There is very little information on what those assets are, their duration, their risk, their rates of a fixed rate, not fixed rate. And most importantly, how that is important to running the core business. Right. Because I do think that nowadays banks have moved away from having a large corporate center with large assets that really don't have a day-to-day impact on running the business, and move on realizing results on running the business day after day.
Andrea, talk to me also a little bit about Banco BPM. So how close are you to getting more?
Well, look, I think they are announcing their plan today, or they have announced their plan today. I haven't had time to go through it. My expectation is it's, again, going to be quite optimistic. I think the question in all of these plans is, number one, you can put a good plan on the board, and let's see if that is the case. The second question is, are you going to be capable of executing it? And coming from 60th quarter of gruesome execution at UniCredit, I do think execution is difficult, particularly now with the environment going against you. So in the case of BPM, I guess, if we're successful, we'll never know. If we're not successful, we will. In the case of Commerzbank, we will have 3 to 4 quarters to observe whether what they put on the board is actually happening or not. That's what I can say. For us, BPM is clear. I think you know how many years it has been rumored because it's very complementary to UniCredit. There are almost no overlaps into the network. There are no overlaps in the clients. We don't see any issue of concentration on SMEs. Actually, we can provide more support, and that's where the value is.
So regulatory approval should not be a problem, you believe?
Well, you never say that, but I would say that if you look at the numbers in terms of antitrust, in terms of a number of these items, we're very far away from having significant issues. So we're quite optimistic about that. With respect to regulatory approval, we're two strong banks, so that should come as well.
Do you think Crédit Agricole is behind you? I mean, it's the main shareholder, there's agreements.
I think, like in any transaction, you need to convince the shareholders of the target to be with you. We think we have had a good shot at convincing Commerzbank shareholders. Look at where the share price is today. And I think on BPM shareholders, we need to do our work and show the value that we will bring, the differential value that we will bring, and why switching from BPM stock into ours can bring them even more value. I'm quite confident. We've had a long-dated partnership with Crédit Agricole in custody, in asset management, in other areas. They know us, so I'm quite confident eventually they will be positive to a transaction, but it's up to them to decide.
But are there active talks at the moment with Crédit Agricole?
At the moment, we are not, and we need to be quite careful with any interaction because we need to treat all shareholders the same and pari passu, and therefore that's why with the offer in flight, we're quite careful.
Do you think the government will greenlight the deal in general? Have you had more conversations with the government?
Well, I do think that if you go back and you look at all the statements that have been made, I think they can be summarized that the government is observing with attention because there are some things that clearly any government looks for. But at the same time, they have been quite clear that they're letting the market function. Yeah. And if that is the case, I think they're doing what they're supposed to do and we'll do what we are supposed to do.
Andrea, are you pretty confident that UniCredit will be a bigger group in 12 months from now?
Yes, I was down by saying yes to your question in Davos. But I do think that one way or the other, the differential value that we will deliver through our main plan is going to further differentiate us from the competition. That should give us the credibility, the currency, to be able to grow through acquisition in the near future.
Andrea, thank you so much for joining us. That was Andrea Orcel, the Chief Executive Officer of UniCredit. Now, tomorrow we also speak to the Commerzbank Chief Executive, Bettina Orlopp, and that's just after 7 a.m. London time. Much more to come. This is Bloomberg. Hon Hai said it's open to buying Renault's stake in Nissan. Hon Hai, also known as Foxconn, has approached Nissan and Honda about possible cooperation. That's as a potential merger between Nissan and Honda stalls. The deal would have created one of the world's biggest car makers. Now, Apple is renaming the Gulf of Mexico as the Gulf of America on its Maps app, following an executive order signed by President Trump. Alphabet made a similar update to Google Maps earlier this week. Yesterday, the White House barred an Associated Press reporter from covering an event in what the Newswire said was punishment for its style guide not adopting the president's new label. Well, a guidance note from AP said the Gulf of Mexico has carried that name for 400 years and the agency would continue to use it. Coming up, the UK and US failed to sign the final communique at the Paris AI Summit. We'll get the details of that and much more next. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Donald Trump directs agencies to work with Elon Musk's efforts to slash their workforces as the Doge head defends his plan to downsize the government. Jay Powell says the Fed does not need to rush to lower rates. Shares edge higher as traders look ahead to today's U.S. inflation print. Plus, Bloomberg learns that China is mulling a $6.8 billion funding plan to help distressed property developer Vanke repay its debt. Now, the Fed chair, Jay Powell, told Congress that the central bank does not need to rush to adjust interest rates, again signaling that officials will be patient before easing further.
Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-term goal. Longer-term inflation expectations appear to remain well anchored. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. With our policy stance now significantly less restrictive than it had been, and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. We know that reducing policy restraint too fast or too much could hinder progress on inflation.
Now let's bring in Elise Badoy, head of EMEA research at Citi. Elise, as always, thank you so much for joining us. Look, there's a lot going on. Just in terms of the news flow, it's pretty terrific. It's coming thick and fast. So when you look at equities around the world, how do you differentiate things that really matter, against the noise?
Well, listen, European equities started the year with a bang, outpacing all of the DM markets. I think it's the best start for European equities since 2000. But obviously, it's in the midst of lots of news flow. I'll go back to fundamentals. We have a result season, actually. So bottom up, we have information for global markets that's coming straight from corporates. It's obviously the news flow in politics, around tariffs with the administration Trump that is dominating the news flow. But investors are getting that bottom-up information. And Francine, it was rather solid. Margins have not really suffered that much. Corporates have adapted to the world with higher rates for longer and quite, sustained inflation. So I think that's important information, which might explain why, also markets have taken a positive outlook at the start of the year. It's not just that general news flow. But aside from that, we continue at Citi to be overweight US. We still see some leg to the European market. It's our favorite diversifier away from the US market. But however, I must give the bad news that some of the extreme bearish positioning on Europe has closed up. So it's now up with fundamentals and seeing new catalysts to drive that next leg.
When you look at some of the things, for example, the inflation report in the U.S., it feels even more significant than the past as we're trying to look through and understand exactly what happens in the U.S. next. Is the consumer going to hold up? Is the labor market okay?
So I think this is key. Obviously, we heard Jerome Powell yesterday, and clearly that view that perhaps, tanking down rates too fast would actually drive inflation back up. So all eyes are going to be on that on the information around employment. Obviously, it still looks very decent. So we don't expect a big drive away from what Jerome Powell said yesterday. We don't expect a big change there. In terms of consumer drive, I think in Europe, the data still looks very much. I don't think there's any very big differentiation between all the different markets. And let's remember that actually the big drive at the moment in markets has been this diversification away from the Magnificent Seven in the US, but also that has led to a diversification towards Europe as well. So I think DeepSeek has been really a very important data point or news that has actually started to shift investors' mind away. And we have seen at Citi a lot of interest. For example, we track our readership. And for the first time, I think, in many years, we've seen that our top 10 most read notes have included 5 European notes. Usually it's US notes. So it's just to show you, I think it's rather than actual pure macro data, people are also looking at these sort of symptoms.
Yeah. And again, when you look at some of the things for European equities, right, it's unclear because it also changes every day depending on tariffs. What's the case for investing or buying into European equities right now?
So I think let's unpick a little bit the landscape. Obviously, away from the news, I think this afternoon we might get new executive order, and we might all be working very hard on that this afternoon. But leaving that to aside for a minute, we have German elections on the 23rd of Feb. That's the next sort of big political point for Europe. The balance of risk for markets is rather positive. So I would say we track the outcomes, and 75% of the outcome tends to be a positive outcome for markets, so deregulation or investment in defense, whether different ways of looking at it, that's good. We believe also that a form of resolution or a path towards resolution for Ukraine is a positive for European markets, leading to perhaps lower gas prices eventually. So those things are positive signals for Europe. But then, of course, there are tariffs, and we believe the rule of thumb we use is that a 10% tariff overall would mean 1 to 2% impact on EPS for Europe. That's sort of our rule of thumb. But unfortunately, the news is that these are going to be very targeted. So if it's your industry, it's going to be 100% of your industry. This will lead to a stock market where perhaps we'll have more stock picking, because once an industry is hurt, perhaps there are winners and losers there that investors can play on.
Elise, is there a danger also that we spend so much time focusing on Trump tariffs, which frankly change everything? Yes. So I'll give you that what happens with China, actually? They're also dealing with a real estate crisis, probably at one of the worst possible times for themselves, and that impacts European equities.
Well, Francine, China is very important, and especially for European markets. A reminder that European markets, are essentially, benefiting from positive news from China, or indeed, if the U.S. market does well, it's good for European economy, for the European stock market. And so I think any news coming out of China will be very important. We sometimes, get our minds taken away from it, but that's absolutely fundamental. And I think a lot of our investors are asking us questions, particularly as we look into the second half of the year.
Is there any place for gold? Again, we see these move to safety. Do you go to cash or do you go to gold?
So I think we've seen a very interesting move in gold. In fact, our commodity strategies would tell you that what we haven't quite seen yet is necessarily that move expressed in ETFs, but we've seen it actually even in Europe in gold equities. So some of these producers have seen a boost in performance. So we definitely see that there is that appetite. I think what our commodity specialist strategists would say is that normally gold is really a correlation to real rates, and we think that correlation is slightly broken. In the sense that actually there's a sense of uncertainty in the world, particularly around the tariffs, particularly around this inability to track where the policies are going, which is driving investors towards gold, and we continue to anticipate that will continue, basically.
Elise, thank you so much for joining us today. That was Elise Badoy, head of EMEA research at Citi. Now, the U.S. and UK were among countries that did not sign the final statement from the AI Action Summit in Paris, which called for promoting international governance over artificial intelligence. Well, Bloomberg's Tom McKenzie has been covering the event and joins us from Paris after, I have to say, Tom, that epic interview with Sam Altman yesterday. But what was the sticking point in the final communique?
Yeah, Fran, I think, look, first of all, it's pretty notable that the UK, which started these summits back in the end of 2024, was not a signatory, as you say, to that final communique. The UK, of course, started Bletchley Park, end of 2024, the UK AI Safety Summit, then handed the baton to South Korea, which handed the baton on to Paris. The UK not a signatory. That is notable. A lot of people are reading into the fact that both the UK and the US were not signatories, and whether or not there was any alignment there, we don't know yet. The UK's complaint around this, or at least their unwillingness to sign off, was down to a couple of points. One, they said there wasn't enough focus on opportunity and security. Opportunity and security. They say as well on global governance, which you mentioned, there weren't enough practical details on what that actually means and how to implement global governance. And then they also said there were some harder questions that remain unanswered around national safety. So those were the main points that the UK alluded to and nodded to when they said they're not signing off on this communique. For the US, it was pretty clear. They said they're not signing off on this communique because of the focus on the sustainability language around sustainable AI and inclusive AI. And for that was enough for the US not to sign off on this communique. India and China signed. along with 60 other countries and organisations. It's worth noting that both the US and the UK say, look, they've been working with the French very closely through this summit. They will continue to cooperate at an international level, but neither country willing to put their names on this final communique at the end of the Paris summit.
Tom, what else was discussed at the summit?
Well, in the first few days, or at least the first day, the focus really was on the question marks about DeepSeek and what it tells us both about China's competitive threat and also what it tells us about these new models, open source, more efficient models. I think one of the key things that came out was I didn't speak to any executive who said that they see a radical and significant dialing back of the spend on artificial intelligence chips and the infrastructure. That was not the message I got from executives. There were different messages about what exactly the impact from DeepSeek will be. Demis Hassabis of Google DeepMind said it doesn't change the efficiency curve. It's not a silver bullet. They probably misled on some of their statements. That was according to the Google DeepMind CEO, Demis Hassabis. The CEO of Mistral, one of the big large language model foundation builders here in France, one of the biggest in Europe, Arthur Munch, he said, I think this is good for the open source community. There remains a big debate as to whether or not these models should be closed or open, and that is a debate as well. And then, of course, the debate shifted around Musk and Sam Altman, and we, of course, spoke to Sam Altman of OpenAI. Interestingly, as well as casting shade on Elon Musk, Sam Altman also said he's been speaking to governments in Europe and those who attended the Paris summit, and a lot of the focus, he said, was on can you build a Stargate, that infrastructure project that the US has revealed, in my country? That's what he said that lawmakers have been speaking to him about. And also, Sam Altman saying the focus was really on what AI can do to boost economies. I think the debate, interestingly, between Musk and Sam Altman in some way distills a crucial question for global leaders and the builders of this technology, which is who controls it, how do they shape it going forward, both at the company level and at the sovereign nation-state level as well. And that remains undecided.
Tom, thank you so much. Again, great interview and great coverage throughout the last couple of days at the Paris AI Summit. Now, coming up, European leaders consider their next move as the EU pledges countermeasures against Trump's tariffs on steel and aluminium imports. We discuss that next, and this is Bloomberg. The European Union has vowed to respond to 25% tariffs imposed by President Donald Trump on steel and aluminium exports. EU trade ministers are set to meet this afternoon for an emergency meeting via video conference to address the measures. Now, for more on all of this, Bloomberg's Brendan Murray and Kevin Whitelaw join us. So, Kevin, what do you think will be discussed at the EU's trade ministers' virtual meeting this afternoon?
Well, you know, obviously the main agenda point will be to simply stay unified as both the European Commission and the member states try to see if they can forge kind of a united response and a united approach as they go into understanding what negotiations might be possible with the Trump administration. The Commission, we do know, has proposed a whole wide list of potential retaliatory measures that can be scaled up or down based on what the Trump administration actually does. But so far it's not been shared with member states. We don't really expect it to be shared today. They really want to keep this close hold. They don't want to provoke Trump into another additional kind of step, but they do want to see how they respond and look like they're showing some firmness and leaving room for negotiations at the same time.
Brendan, I mean, you're in charge of trade wars, I guess, overall. I mean, how is the Trump administration dealing with Europe differently to the first time around?
Well, I think it's pretty clear in the first 3 weeks of this Trump administration that tariffs are a negotiating tool to drive you to the table, yeah. and certainly 25% tariffs on steel and aluminum from Europe will leave economic damage in Europe. So there's a month they have to work this out, and so it should we'll see what the Europeans what their next step is, but clearly the fight this time will be different. It was about BMWs and bourbon during Trump's first term. It will be much more complicated now as he looks to use lots of different authorities to put tariffs on U.S. trading partners.
But Brendan, how much leverage does the U.S. actually have over Brussels?
Well, It depends on what kind of leverage you mean. Economic leverage, you look at the U.S. state of the U.S. economy. The U.S. economy is doing very well right now. The unemployment is basically full. You look at countries like Germany, and they're doing pretty poorly by comparison. So the economic leverage seems to tilt toward the U.S.'s side. You could argue that political leverage is also tilting toward Trump's side, given the situation in France and Germany.
And Kevin, I thought actually the J.D. Vance speech at the AI summit in Paris was very, very tough on Europe, because he basically said, fall in line, be optimistic on AI, and don't look at it with trepidation. Again, what do we know about the personal relationship with the Commission president and the U.S. administration? Does that change in this environment of a trade war?
Well, it's going to be really interesting. The European Commission's had very little, direct, connection yet with the Trump administration. We did have a meeting between Ursula von der Leyen and J.D. Vance in Paris. It's the first time they'd met. They really have not had good lines in and good lines of communication. So one of the things the European Union is going to need to do is figure out who can they talk to, who can they even make their case to, who are they going to negotiate with. We're still waiting for the Trump administration to get some of its main trade officials confirmed. So establishing that relationship is going to be super important. But there are so many factors, including the EU's tech policy, that have a potential to drive a real collision with Trump, that even beyond trade, there's really a huge number of friction points that could really make this relationship extremely volatile for the next couple of years.
Yeah, and Brendan, I know we hear from, corridors inside Brussels or inside the Elise saying, look, we can retaliate. But at the end of the day, it just seems like it's an unfair trade war.
Yeah, absolutely. Look, this is a $6.5 trillion economic relationship when you add trade and investment together. Neither side really has an incentive to blow the whole thing up. So what we're seeing is Trump, show a few of his cards up front, and the Europeans, as Kevin said, are going to have to stay unified if they're going to see the kind of strength that he's applying on them. If they can apply the same sort of economic and political pressure.
Okay, thank you both for joining us. Brendan Murray, of course, who's in charge of trade for Bloomberg, and Kevin Whitelaw, our bureau chief in Brussels. Coming up, as the UK's fiscal watchdog is set to cut its growth forecast, we'll also look at the government's increasingly stretched financial situation. That's next, and this is Bloomberg.
On February 23rd, Germany heads to the polls following the collapse of Chancellor Scholz's coalition. With the focus on the economy, migration, and geopolitical tensions, how will the German balance of power shift? Bloomberg Television has continuing coverage leading up to the election and will bring you the results after the votes are tallied with a special post-election broadcast. Tune in February 23rd, starting at 5 p.m. London time. Only on Bloomberg. Context changes everything.
We'll get fourth quarter GDP numbers for the UK tomorrow. Now, economists reckon output fell 0.1% in the final 3 months of last year, following a stagnant third quarter. Now, this amid a fallout from the tax-raising budget, leaving Britain back on the brink of recession. To discuss this further, I'm joined by Dan Hansen from Bloomberg Economics. Dan, always great to speak to you. Actually, we did a podcast together also trying to understand the way forward for the UK. And frankly, the path for Rachel Reeves is not clear because she just has less money.
Yeah, she does. I mean, we've got, as you said there, we've got GDP in the morning. We expect the economy to contract. And we've had a scoop from our Bloomberg News colleagues about the fiscal position and how the OBR is going to potentially treat what has been 6 months' worth of pretty bad news on the economy since Labour came to power. So we've had no growth, as you said, in the third quarter, potentially a contraction in the fourth quarter. So I think from the OBR's perspective, you take all that news together, at the very least, you're downgrading your growth forecast for 2025. And the story overnight from our news colleagues suggests that they might do something a little bit more than that about the growth outlook further out. And that's what matters for the fiscal position. It's not necessarily what happens with growth this year. It's the cumulative or how big the economy is in 5 years' time. And if there's a downgrade to that, it sort of adds to the challenge, not only that's been presented by the economy, but it adds to the challenge from higher interest rates as well, which has been the story since the start of the year.
So how does she fix it? What are her options?
Well, she's ruled out tax rises, so we can say no to that. So that leaves spending cuts, and you have two options there. One is departmental spending, which is sort of day-to-day government spending, like wages, procurement, things like that. The budgets there were already very stretched in the budget that was put out at the end of October. So doing that is going to be extremely difficult for some government departments, and you would argue possibly undeliverable in terms of the budgets that they would be handed in that environment. The other option, of course, is benefit spending, and there have been some noises around that, around disability benefit spending that Rachel Reeves has been speaking about, saying that the bill is bloated, trying to get people back into work. So there are two options. I think there'll probably be a bit of both, to be honest with you, because I think on the departmental spending side, there'll be questions from financial markets about credibility of cutting spending that far and that deeply. And the thing with benefit spending, of course, is you can do it immediately. So it kind of acts as a down payment on credibility if you're looking to shore up financial markets.
But would that be enough? I mean, it really depends on GDP. I mean, it really depends on the numbers and the cards she's dealt, right?
I think there'll be a question mark. If the OBR makes a downgrade in the March fiscal statement, a modest downgrade is what it sounds like. It doesn't sound like she's miles offside with her fiscal rules. I think the question will be will there be a bigger downgrade further down the line come October? And I think financial markets will be watching that, because one of the question marks I think investors have about UK fiscal policy is the path of deficit reduction is predicated on quite optimistic growth forecasts. Right. So I think the question will be has the OBR gone far enough? Yeah. And if the economy continues to disappoint over the next few months and into the end of the year, then another downgrade might come again in October or the budget at the end of the year.
Dan, thank you so much. As always, Dan Hansen there, Bloomberg Economics. This afternoon, Fed Chair Jay Powell continues his testimony before Congress. That's at 3 p.m. London time. We also get the inflation print. Now, up next, Bloomberg Brief. Danny Berger, Manus Crime in New York. And this is Bloomberg.